My name is Junheng Li. I run a data a research company called Zer0es Capital. Our clients call us the China intelligence agent in a sense that we are commonly used as their outsourced China analyst. And our job is to provide value-added research to help them to reach conviction of in their thesis, whether it's long or short. Our edge is we have extensive resources in China. We cover a fixed sector for our clients, investors. Those are the retails. Lots of them are multinational retailers. So we are market researcher, and we provide our clients with high frequency data and the channel checks. So I actually grew up in Shanghai, and I came here for college and then a business school in New York later on. So I was a banking analyst, but it took me about a year to realize banking is not for me. It's too transaction oriented, and I enjoy research a lot more. So I moved to the buy side. Initially at a Franklin Templeton fiduciary, and then at a hedge fund. And about 2000, after the financial crisis, I decided to launch my own business because it's nice to work for yourself, and it's a great opportunity to develop the skill set. So our differentiation is we focus not only on the Chinese businesses, but also multinationals. Say, for example, everyone wanted to know how Nike was impacted by the cotton event and how luxury brands trending after COVID outbreak in China. So those are research that's so China-centric, but the coverage itself is mostly provided by Western analysts, and we fill that gap of sort of dislocation. So that's the value added of our product. We also cover special situations. For example, I guess the purpose of this conversation is short selling one-on-one, and there are lots of short candidates coming from China. There's no surprise, because when you have a massive amount or number of IPOs from a certain country, the short candidates go up proportionally as a percentage of the IPOs, because the odds of company or businesses succeed and fail is approximately fixed over time, right? It doesn't mean that you have more businesses seeking public financing. It implies more success, right? You have more companies that are going to succeed and more companies going to fail. And especially the companies that came here during Trump administration, knowing that the US-China bilateral geopolitics tension is accelerating, but then they still decided to come here for fundraising. That in itself is very interesting. There are a couple of explanations. One is that the pre-IPO VC investors, they clearly expressed a liquidation preference. They want the liquidation to be in the US dollar, right? And then they could be, they are not qualified for domestic or Hong Kong listing, and that's very common as well. But that as the US IPOs go up, we found more and more sort of immature companies. Companies are not public ready. Companies that come here for the IPO simply because the insiders wanted to get out, and they've been in it long enough, and they know that the competitive landscape is getting more and more intense. Government regulatory environment is getting unfriendly. So they knew this before the public market knew. So, it is really a liquidation event for them. In those situations, I think investors, especially retail investors, should be very careful about the stories that they pitch to the public markets. And you have to think more critically whether you want to fund the insiders' exits. So, I think someone in your program mentioned this short strategy, capturing the unlocking IPOs, right? I think that strategy has been working pretty well for lots of recent Chinese IPOs. Those companies tend to have low moat, but very high, valuation. And that coupled with deterioration in fundamentals, those are perfect candidates for short selling. And in the case of IPO lockup expiration, that provides you with a very precise catalyst, right? Weeks into lockup expiration. That's a very good opportunity or timing to build the positions. I mean, those are sort of what we call like a bubble shorts with deterioration in fundamentals. The other group of shorts are outright frauds. There are some of those companies in any country. I mean, probably more so in emerging markets, just because by definition, emerging economies are immature, right? The track record is shorter. So they're still learning how to function and grow and develop a business and economy to the standards of a Western mature developed economy. But you see frauds in the US, you see frauds in Germany, everywhere. One example that's in the public eye because it's so well discussed on Twitter is this K-12 tutoring vendor. It's called GSX. Now they changed the name to GoTo. I mean, it was an outright fraud, but typically I think busting fraud is so much harder than busting like a bubble shorts with high valuation and deteriorating business fundamentals. Because fraud, when you trying to bust a fraud, essentially you're trying to bust the entire system supporting the fraud in the first place. You're fighting against investment bankers who brought the company to public. You are fighting against the Deloitte or whoever, the auditors that sign off on the fraud, right? And you are fighting off the insiders or pre-IPO investors who wanted to get out. So, I mean, it is a much tougher battle, but a lot of times, for unknown reason, business can collapse. So like in the case of Luckin, it could have stayed fraud much longer if it were not for COVID, right? COVID business killed all the commercial retail traffic. So no one went in to get coffee anymore. So the hole that they need to fill in, becomes greater and greater as days goes by, right? Typically, I think frauds or the fraudulent management, very few of them wanted to stay fraudulent. All of them wanted to eventually grow into the bubble that they created in the public perception, right? So they're actually working pretty hard to try to fill the gap. But sometimes, a lot of times it doesn't work because, if you are a business that with a non-sensible business model, or you have, a very low quality operator working on the business, I mean, it is hard to lead or to grow a successful business, right? So in this, I mean, COVID really, triggered a lot of significant material changes in lots of businesses. I mean, COVID killed the retail business, including Luckin, but it propelled online learning business. So when GSX was written by everybody as mostly fraud or a fraudulent business, that's when actually the COVID outbreak started in China. So that pushed all the parents register classes for their kids online, because they couldn't, or the offline classes were closed. So GSX actually rode this wave, and their enrollment grew off low base, right? On a relative scale, the business actually expanded for them. They were able to use the cash to pay and hire more tutors, more salespeople. So the business itself was on a positive trend till this regulatory crackdown. So GSX, on the hindsight, I mean, on paper, it looks like a great short, right? I mean, people who shorted from 140 to $3 today had a great, paper win, but the journey has been very difficult. So it was not an easy short by any means. I mean, the pain, psychological pain, the volatility along the way was very, very challenging. So, I mean, I think, this is, back to the point, I think in general, frauds are very hard to short because you can't identify with a very precise timing what's going to happen to trigger the collapse of the business and to bring, the street perception of the business to yours. I mean, I think a lot of informations are in public for investors to study and to analyze, but lots of people just don't bother to do the work, or they don't have the skill set to do the work, right? So, I mean, I think prospectus is a very essential document for everyone to review if you want to understand what the stock is actually about. When we look at the IPO, a prospectus is the first thing that we read. And in that document, we read 3 segments most carefully. Capital structure. So you want to know who are the pre-IPO investors and what's their time horizon and when did they get involved. So give you an example. A couple of times, the examples that I have on top of my head would be Xiaopeng, which is an EV OEM in China, came to the US in 2020. I believe it's second half of 2020 for IPO. So it raised a bunch of capital months before IPO from a wide group of hedge fund investors in Hong Kong. And the explanation, or the possible explanation, was that they never thought that they would manage to pull the IPO through, given the COVID and slow down in a retail traffic. No one went to the store to order their cars, et cetera, right? So because when COVID broke out in January in China, everyone thought that it was a major it was a major health crisis. It might linger for months and no one was on the street and no one wanted to be out and about, right? And government quarantined cities and the markets, et cetera. Retails as well, shopping malls. So they raised last few rounds of private placements from the hedge fund community at price. I mean, I could be wrong, but like on average might be like low to single digits in US dollars. Then it came to the US, IPO'd at $12, $14. So just imagine if you were a hedge fund, you just made a couple of baggers over a few months. What would you do, right? And it's, this business, for it to carry on, you have to raise more funds, raise more capital, get diluted, and you don't really know because there's so many people making new energy cars now. You don't know who will be the ultimate winners. So if you can flip it, why not? So that's exactly what people did. After the lockup, not even after the lockup expiration, even just weeks or months before and approaching the lockup, people started to sell. So you have this selling pressure add up. I mean, we see lots of those examples, cases. I mean, Junheng Education is another one. I mean, it is online learning, online tutoring, but it's one-to-one tutoring format. So when you look at a capital structure, you realize that, I mean, first of all, the company is relatively young, raised the frequent rounds before IPO. Insiders might just feel that the timing, the window for liquidation is narrowing, or possibly like will disappear very quickly. So they wanted to rush out, and the company is in the public market, not exactly to raise the proceeds to expand the business, or, I mean, there's no specifics as to where the management is going to allocate the additional capital, right, to offset the dilution to existing shareholders, but rather it is doing IPO for the sake of IPO. So, I mean, those companies, I mean, they're not great candidates for loans. And then, against the backdrop of the tightening of tutoring business in China and the uncertain, regulatory environment, those are all very, appetizing short candidates. So, I mean, capital structure is very important, and risk factors, always read the risk factors, because companies actually tell you in those writings what can go wrong to make them suffer. So you want to know those factors very well, and you want to like analyze the temperature of existing, operation environment to know like which cycle, regulatory policy, or like a business cycle you are in, vis-a-vis what the story that company tells you. And then business overview, of course, you want to know like what's the revenue model, where they can manage their growth and manage their cost to deliver profits to people. When you see a business that's growing like a weed, but they're spending $200 on the marketing and the sales expenses to deliver $100 revenue, that's not exactly the business you want to be in. That's called, burning cash to buy share. I mean, if I sell my research for free, I can be a multi-billion-dollar business, right? Because, I can say, my revenue is what the price I could charge by minus deduct the rebates that I give to my clients, right? So, I mean, I think capital alone itself is not a moat. Because, I mean, given the synchronized central bank liquidity easing around the world, right? Money is abundant everywhere. So you've got VCs rushing to China, but that's been the trend for the past multiple years. I mean, now people started to realize maybe China is hitting the wall. They're repeating the same thing in maybe India, right? So, I mean, you have this very easy liquidity environment. And then, I just think that the capital alone, you have to be very careful. If you just achieve the scale of business by burning cash, that's for sure not sustainable. And just don't be thinking that because certain high profile VC is involved in a deal, you have to be in the deal too, because their business model is so different from yours, right? I mean, SoftBank made multi-hundreds, baggers on Alibaba, on Yahoo, but it completely flopped on like many other deals. I mean, their game is to have 1 or 2 hits out of 10 and have like, and then they can afford to have like, 5 or 6 flops, but you cannot. As public market, it's a different rule of game.